Good morning and welcome to this presentation. You'll remember yesterday that I'll be coming back today to do the cash flow statement, stock valuation methods, and ratio analysis. But before we get to that, I want us to go back just to recap quickly on what we did yesterday, especially the income statement. You will remember yesterday I said when preparing the income statement, the first thing that you need to do is consider the information as given in the pre-adjustment trial balance with specific reference to the nominal account section. Put in everything that is supposed to go into the income statement. For example, put in your sales, open up the brackets, put in your sales amount, followed by cost of sales, open up the brackets, put in the cost of sales amount. If you've got debtors allowances, deduct that immediately from your sales amount, but without giving the final answer. If you've got an item, for example, under expenses, wages and salaries, put it in, open up the brackets, put in the amount. All this must happen in the details column. And what you also need to remember, what I said yesterday, after you've done that, you move on to do the adjustments. You consider the adjustments. As you adjust, remember what I said yesterday. If you make an adjustment under other income, the new account associated with the adjusting amount will have in its name the name income. It will all depend whether it is accrued or income received in advance. It will all depend on whether this income is outstanding or was received in advance. You will then have accrued income or income received in advance. The same can be said of expenses. When adjusting an expense item, remember again that the new account associated with the adjustment will have in its name expenses. If the amount is outstanding, it will then be accrued expense. If the amount has been received or paid in advance, if the amount has been paid in advance, it will then be the prepaid expense. And you take that to your notes immediately. The last thing that I want to say around the income statement before we do the depreciation adjustment, remember whenever you add, a plus sign means a shortfall and therefore accrued income or accrued expenses. Whenever you add something to an amount under other income or under expenses, it means that amount has not yet been paid or has not yet been received. It's outstanding. And it will then mean the new account will be either accrued income or accrued expenses, depending on where the adjustment is being made. And the minus sign where you've got to deduct, and what you deduct is basically the surplus amount either paid or received. And in the case of a payment, it will then, the new account will be prepaid expense. And in the case of income, it will be income received in advance. Yesterday, before we parted ways, we were to do one last adjustment of the three adjustments. Remember, we did an adjustment on the insurance, we did adjustment on the rent, and I promised that today we'll be doing an adjustment on depreciation. You have there on your screen under additional information, number 3, depreciation is written off on vehicles at 20% on the cost price. An additional vehicle was bought on the 30th of August 2013 for 200,000, and this was duly or properly recorded. But before you attempt this adjustment, let me just say this quickly regarding the writing off of depreciation. The important thing to note is check as to whether there were no additional fixed assets, vehicles or equipment that were bought during the course of the year, or whether there were no disposals. If you had an additional vehicle bought during the course of the year or additional piece of equipment bought during the course of the year, you shall have to work out depreciation on that proportionally. That is for the period over which you had the piece of equipment or the vehicle, not for the entire year. And And where we have disposed of an asset during the course of the year, just determine the date on which the asset was disposed of and work out depreciation up until the date of disposal, taking out the unexpired period. You must not consider the unexpired period. And then that's how you go about working out depreciation. Oftentimes we do make mistakes there by working out depreciation for the entire year. The asset was disposed of during the course of the year. We did not have it for the entire year. Now, I want us to do adjustment number 3, the depreciation, and our short exercises quickly. And I'm going to give you about 3 minutes to do this quickly. Adjustment number 3. Take 3 minutes just to work out depreciation there. That will be shown in the income statement. Thank you very much. Welcome back. Let us quickly go through the exercise. I hope you find it quite interesting, and I'm sure you've got it right. Let us work it out together. Let us work it out together. Your vehicles at cost following the pre-adjustment trial balance on the 28th of February is 900,000 rands. That is from given information. And depreciation is 20% on cost, on the cost price of your vehicles. And during the course of the year, on the 31st of August, you had additions, or you bought an additional vehicle for 200,000, sorry. In calculating depreciation on your vehicles, that will be shown in the income statement. What you need to do, let's do it this way. Establish first the balance of your vehicles, or the value of your vehicle, as at the beginning of the year, as at the 1st of March 2012. Remember, your year ends the 28th of February 2013, and we are told as at this date, your vehicles total 900,000. And somewhere during the course of the year, on the 31st of August, which I guess is halfway during the course of the year, you had additions of 200,000. There were additions. Additions will indicate that by plus. Now the question is, what was the value for vehicles at the beginning of the year? So it is 900 minus 200, that means to 700. You have your vehicles, 700,000 plus 200, that gives you 900,000. Now, remember I said in working out depreciation for additions or for disposal during the course of the year, you've got to do that proportionally. Now, you can either do this to say your 700,000 can work 20% on the 700,000 for the whole year. That will give you 140,000. That is for the whole year. And say the 200 was only for the period, or from the period 1st September or 31st August to February. Let's count. It's September, October, November, December, January, February. That's the 6 months. So you'll have a 200,000 times 20% times 6%. That's being proportional. That's working proportional. And that will give you 20,000. And if you add the two, you'll have 160,000 rands. That will go in your income statement under expenses. Alternatively, you can work it out this way, that from March to August, the value for vehicle was 700,000. We've got 20% of that. March to August, that will give you 6 months. March, April, May, June, July, August, times 6 over 12. And that will give you 70,000. And from August, or from the 1st of September to February the 28th, the value of your vehicle change from 700 to 900. So you'll have your 900 here as the capital, 900,000 times 20% times 6 months, which is fair, because that changed only halfway during the course of the year. That value changed only halfway during the course of the year. And 20% of this will give you 90,000. 90 plus 70 will give you 160. Same answer, and this is the amount that will go in your income statement. You can either do it this way or this way, whichever way you find it easy for you. Come the 28th of October, next week Tuesday. Right, but please take note, whenever you dispose of or use additions during the course of the year, please your depreciation on the asset that you have disposed of or on the asset that you have bought, the depreciation must be worked out proportionally. Okay, let's move on. Let's move on. I want us to move on to the balance sheet. Remember, I promised that to be doing the balance sheet today. Wrap it up and move on to the cash flow statement. I'm not going to take much time on the balance sheet. I don't intend to spend a lot of time on the balance sheet, but I'm going to do this, the balance sheet, couple this presentation with ratios or financial indicators. Like all other financial statements, it is also important that you understand and you know the format of the balance sheet. That's the only way. And over above that, it is also important, I've said I'll couple this with a ratio analysis, that you know your financial indicators or ratios formulas by heart. Why is it important to know them by heart? Because oftentimes in the balance sheet, you are asked to determine certain values. And amongst other information provided or supplied to you are financial indicators. So knowing your ratio or formulas will assist you to pick up the relevant financial indicator in determining the absolute value. I want us to go again into another short exercise regarding the balance sheets in order for me to explain this properly. Let us take a look at the balance sheet here. This is an extra from the balance sheet on the 28th of February 2013. You have the current asset at 900,000. You're not given the shareholders' equity there, and you'll need to determine that. You'll need to determine that. You'll need to determine your shareholders' equity. You're not given the share capital. You'll need to determine that. You're not given the retained income. You also need to determine that. And all other things like the mortgage loan, the current liability, trade and other receivables. You're given the shareholders as 450,000 rands. This company has an authorized share capital of 1 million ordinary shares, and it has an issued share capital of 800,000 ordinary shares. All the shares were issued in 2010. No shares were repurchased during the course of the year. An interim dividend, totaling 300,000, was paid during the course of the year, or interim dividends totaling 300,000 rands were paid during the course of the year. You've got the financial indicators. I'm not going to take you through again the theory around the balance sheet and so on. All I want us to do, let us quickly do this exercise. I know it's going to take you a bit of time, but let us try to do it. I am going to give you I think it will only be fair to give you 15 minutes. You've got 1, 2, 3, 4, 6 items to what you call, to calculate. I'll give you 15 minutes to do this exercise. Consider the financial indicators given here. Consider all the information given to complete this extract from the balance sheet. Thank you. Guys, let's do the exercise together. I hope you've got it right. You're able to determine the missing figures. And you're able to finish, of course. I'm sure you're able to finish. This is just to highlight the importance of knowing your formulas by heart and applying them to determine absolute values. Look, in this small exercise, you're required to determine your shareholders' equity, your share capital, retained income, loan, and the current liabilities with that given information. Let's quickly move on to, let's determine first the shareholders' equity. The shareholders' equity, that my paper's okay. My paper's okay. Look, in determining the shareholders' equity, you need to pick up from your financial indicators a financial indicator which has in its formula shareholders' equity. Capital reserve sometimes referred to as shareholders' equity. So you need to pick up the relevant financial indicator to use. And in this instance, the relevant financial indicator would be net asset value per share. For NAV is equals to shareholders' equity divided by the number of issued shares. Your net asset value per share is given as 400 cents. Is equals to SHE. And what we also have is the number of issued shares, where we have 800,000 ordinary shares issued. So divide by 800,000. Therefore, shareholders' equity is equals to 400 times 800, or 4 and some 800. That will give us 3,200,000. 3,800,000. Just for those who are not so sure about how to arrive at this, you just change this, swap around this 2 around. You say SHE divided by 800,000 is equals to 400 cents, which is 4. Then you multiply this. We are solving for SHE. You multiply this by 800,000. And you must also multiply this by 800,000. Remember, what you do on the left-hand side of the equation, you must also do on the other on the left-hand side of the equal signs must also do on the right-hand side. Therefore, she is equals to 3,200,000 rands. Once you've determined this, then you go to your balance sheet, to extract, you put in 3,200,000. That's the first thing that you've determined. Oh, sorry, supposed to be here, not there. 3,200,000. Right? Then the next thing is your share capital and your retained income. Let's go to your retained income. I think best we start with the retained income, and the share capital will be the balancing figure in this instance. Looking at the given financial information, you have amongst financial indicators, earnings per share. You also have your retained income at the beginning of the year. If I may go quickly to that, so that just to refresh your memory on this. Following the supplied information, you have earnings per share, 100 cents. You've got your retained income. What you need to do in determining your retained income at the end of the year, you need to take all relevant information and in a way prepare the retained income note. You've got the balance at the beginning of the year. What you need is net profit after tax, which is not given, and minus dividends for the year. And you've got dividends at the end of the year, 400,000. You've got the interim dividends of 300,000. That should not be a problem. The difficulty is the net profit after tax, which is overtly given. But you must look for a financial indicator which has in its formula net profit after tax. And I guess in this instance, the quick one to use will be earnings per share. Most easiest and quick one to use will be earnings per share. Because remember, earnings per share, the formula for earnings per share is EPS is equals to net profit after tax divided by the number of issued shares. We've got the number of issued shares as 800,000. We've got your EPS for 2013 as 100 cents. And it should therefore be easy to determine the net profit after tax. Let's do just that. Let's do just that. We say EPS, earnings per share, is equals to net profit after tax divided by the number of issued shares. Your EPS is 100 cents. Your net profit after tax, not given. And your number of issued shares given. It should therefore be possible to determine your net profit after tax. Again, it will be 100 times 800. 1 rand times, because these are cents, it will be 800 cents. 800,000 rands. Cross multiplication. Therefore, net profit after tax is equals to 800 rands. Again, just for some of us who are not so sure of the mathematics, you can swap these things around and say net profit after tax divided by the number of issued shares, which is 800,000 in this case, is equals to 100 cents. Then you multiply this by 800, and you must also do same this other side. Therefore, net profit after tax is equals to 800 rands. Once you've determined your net profit after tax, then it should be easy to work out your retained income at the end of the year. Remember that note, retained income at the end of the year, retained income note. You have your retained income, I'll abbreviate. You've got balance at the beginning of the year, balance at the beginning of the year, which is given as 650. Then we've got your net profit after tax, which we have determined. How much? 800,000. You've got your dividends paid. Paid is 300,000, sorry. 300,000. Recommended or declared, you've got that as 450. So that gives you 750 that you must deduct. Then you've got to balance at the end of the year, the balance of your retained income at the end of the year. That is the figure that we are missing that we've got to work out. And that's the figure that we've got to put in our balance sheet. So you've got 650 plus 800,000, that gives us 1,450,000 minus 750, that should give us 700,000 as your balance of the retained income at the end of the year. Then you go to your balance sheet and you put in the figure 700,000. So the difference between your shareholders' equity and your retained income will be your share capital, which in this instance is 2.5 million. Right. You move on to do your non-current liabilities, where we have your loan there, your long-term loan, and of course you also have your current liabilities. Let me put in the structure quickly. You've got a trade and other payables. We are also given the shareholders for dividends. You'll pardon my handwriting. Your shareholders for dividends given is 450 as a given figure. That should not be a problem. Right. Let's get to the loan amount. Following your financial indicators again, if I can take you back again quickly to financial indicators. You need to pick again the relevant financial indicator to use. And quite obviously it is debt is to equity, loans debt. So the proportion, that is debt to equity, that's the proportion of your debt to equity. Now, how much debt are you losing in relation to equity? In this instance, we have it as a 0.2 is to 1. So the proportion of our debt to equity is 0.2. And therefore, your loan amount will be 0.2 times the shareholders' equity of 3.2 million. Right? Let's work it out. There's a loan. We're told it is 0.2 of your equity. Your equity is 3.2. Your debt is 0.2 or accounts for 0.2 of your total shareholders' equity. So if you multiply 3.2 million by 0.2, it should give you something like 600 and 1, 2, 3 times 0.2, 640. 3, 2, 1, 2, 3 times 0.2, 640,000. 640,000. That will be your loan. That will be a loan. And We don't have a figure for trade and other receivables. We also don't have a figure for current liabilities. Again, understanding your ratios properly, it will mean to determine your current liabilities. What you need to do is to pick up again here the ratio that is relevant, or the financial indicator that is relevant to you, so that that is relevant to the determination of your current liabilities. So in this instance, we have the current ratio, which is 1,8 is to 1. 1,8 is to 1. So, and you are given your current assets. You are given your current assets of 900,000. That means your current assets are 1.8 of your current liabilities, 1.8 of your current liabilities. Now, to determine the current liabilities, you need to divide that figure by 1.8. Let's do that. If you divide 900,000 by 1.8, it will give you your current liabilities. It should give you current liabilities. This will be 900,000 divided by 1,8. Let's do it. 900,000 divided by 1.8. That gives us 500,000. You can work back. You can multiply that 500,000 by 1.8, and that will give you 900,000, which is proof enough to say your current assets are 1.8 of your current liabilities. Right. And what will be your trade and other payables? It will then be the balancing figure between the two, which is 50,000. 50,000. So I think it is important that you know, I want to emphasize this. It is important that you know your formulas by heart. Very, very important. For the purposes of determining absolute values, for the purposes of calculations and application. Right. In the past year's question papers, we have seen in those question papers candidates being asked to calculate certain financial indicators, calculate the return on total capital employed, calculate dividends per share, calculate return on shareholders' equity, etc., etc. You can only be able to do that if you know your formulas by heart. Otherwise, without those formulas, you won't be in a position to do the calculation, to calculate those. The information will always be there. The correct and relevant information will always be given. All what you need to do, you need to apply the formula. So if you don't know it by heart, there is just no way under the sun that you'll get that right. So that is thrown away, very easy marks to collect. And oftentimes marks allocated to there are not less than, they range between 12 and 18 marks. Let's put on average 15. I mean, that's a lot of marks. 15, that's 5% of the question paper marks. Easy giveaway marks that you need to collect. Secondly, you get this thing, this what's called the application, or rather the formulas being used in determining absolute values in completing, oftentimes, the balance sheet. We have seen that in our papers in the Free State in March. We have seen that now in September. It is therefore important that you go home, you make sure that you understand those, you memorize those basically, so that you're able to apply the formulas. Secondly, around the ratios and formulas, it is not only enough to memorize the formulas, but you must also know and understand what each ratio measures. What type of a ratio am I dealing here with? Am I dealing with a liquidity ratio? Am I dealing with a profitability ratio or operating efficiency ratio, solvency ratio, risk ratio, etc.? It is extremely important that you know that. Why? Because oftentimes, if you go back to past year's question papers, including this year's provincial common papers, You'll always pick up a question where you're required to comment on either the liquidity position of the company, on either the operating efficiency of the company, or solvency, etc. Oftentimes you get a question going like this, that the board of directors is happy with the improvement that the company is beginning to show in its liquidity or in its liquidity position. And you'll be asked to quote two or three financial indicators with figures to either support that kind of feeling or that kind of an opinion. Right? So knowing what each ratio measures, that should not be difficult for you to do. If they say comment on the liquidity position of the company, you have your financial indicators given. All what you need to do is to look at those indicators and comment accordingly. Pick the correct financial indicators that look, current ratio. What has happened to it? It has improved from, or it has declined from to this, because they always say with figures. Then we've got your 3 easy or giveaway marks. They may ask you to comment on the profitability or operation efficiency of the company. You should be able to know, or you should know basically, which ratio measure the operating efficiency of the company. It is very important. At times they may give you a situation where maybe the directors are at loggerheads insofar as utilization of additional loans is concerned. Others saying, no, we are for additional loans. Others, some saying we are for additional loans. Others saying, no. It is not what you call advisable that we take more loans. And you may be required to come in, to step in and give advice. But you need to look at the financial indicators and apply the correct financial indicators in providing that kind of advice. You look at how risky is the company. You're looking at questions of gearing. Is it lowly geared or is it highly geared? Is it highly risky or is it lowly risky? Right. That means you'll be guided here in this instance by your debt equity ratio, the extent to which a company employs borrowed capital in relation to its capital. In our example here, for 2013, for every rand that the company contributes, for every rand of its own capital, they only have 20 cents that they're using as borrowed capital. So the ratio is rather too low. It is low risk. But it can be extremely risky where you find a situation where the debt equity ratio is 0.9, for example, is to 1, where almost debt equals or borrowed capital is equals to your own capital. That situation is a bit risky. So you look at those. You're not only looking at debt equity ratio, you must look also at the return on total capital employed. Because remember, your borrowed capital forms part of your total capital employed. Are we getting returns out of that? So those are kind of things that you'll be looking at. Pick up the relevant ratios and talk to those ratios in providing advice, whether to use additional loans or not to use additional loans. Right, you must be scientific in providing that kind of advice and provide, of course, evidence. Yeah. All right, this was just to emphasize the importance of ratios, knowing the formulas by heart, and of course, commenting. Because if you look again at the marks allocated to ratios, calculations, application of ratios, plus commentary, we're talking more or less 40 to 45 marks of the question paper marks. 40 to 45 marks. And those are giveaway marks that you need to collect. That area is never difficult. The key to this is know your formulas by heart, know what is ratio measures. That is all. Please go do it. Today, if you're not sure of your formulas, you don't know by heart, it is never too late to mend. Go memorize them, please, so that you get that 45, you get those 45 marks. What percentage is that of the question paper? 15%. Then that's it. Let me step off these ratios and the balance sheet. I wanted to explain the balance sheet along the lines of the ratios. I want us to move on to the cash flow statement. We are going to do one or two activities around the cash flow statement. But before we do that, let me quickly just explain the cash flow statement. I hear oftentimes that the cash flow statement can at times be challenging, can be very tricky, and some of us are kind of struggling doing the cash flow statement. I've heard that before. I'm not so sure whether that perception is correct or not, but I take it is not entirely correct, entirely true. If you look at the cash flow statement, like any other statement I've said since the beginning of my presentation yesterday, you know, for you to be able to prepare any financial statement, what is important, what is key, you must understand first the format of the financial statement that you're dealing with. Let's get to the cash flow statement. If you look at the cash flow statement, the statement is subdivided into 3 sections. It's all about the cash flows. Cash flows from operations or from operating activities. Cash flows from investing activities. Cash flow from financing activities. And the net result there is net change in cash and cash equivalents. And will be expected to add to the net change in cash and cash equivalents at the beginning of the year, and ending up with cash and cash equivalents at the end of the year. You add cash and cash equivalents at the beginning. Did I say the end? I heard myself saying at the end. But at the beginning to the net change, and you end up with cash and cash equivalents at the end of the year. What falls under cash flows from operations? There are very few things. One is cash generated through operating activities. That comes from the note that you normally refer to as reconciliation between net profit before tax and cash generated through operating activities. It comes from that note. We'll talk about that note a little later today. You've got your interest there, which is an outflow. You've got your dividends paid. You've got your taxation paid. All outflows, with the exception, if of course it is not negative, mainly, more often than not, with the exception of the cash generated through operating activities, if it is not negative from the reconciliation. But these other items that I've mentioned, interest expense, dividends paid, taxation paid, or tax paid, all will be outflows. That means you have to put all those amounts in brackets. We'll talk about the application of brackets hereafter. And this will be followed by cash flow from investing activities. Cash flow from investing activities will have fixed assets purchased. You will have proceeds from sale of assets. You'll have, of course, changes in your investments, if there are any changes, either increase or decrease in your investment, fixed deposits and so on. And then the last section will be cash flows from financing activities, proceeds from sale of new issue, sale of new shares, or from issue of new shares. You'll also have your loans there, either redemption or an increase in loans and so on, or loan payment. Mainly you'll have those, and you've got your net result. What is also important, looking at the cash flows from operations, where do you get information from to prepare that section of the cash flow statement? When you prepare that section of the cash flow statement, you need to mainly focus on, amongst other things, your income statement, because it is where you get your interest expense and also your notes to financial statements, or to some extent you'll also get some information from the balance sheet itself to prepare that. But largely it will come there. We'll talk about that. And getting to the second part, flows from investing activities, your focus here, or information your focus here would be on your balance sheet. And which section of your balance sheet, your assets, your non-current assets section. You look at that. You look at the change in your fixed assets, your tangible assets, right? You look at your fixed deposit, etc. That will assist you to determine the cash flows from your investing activities. And your investing activities, again, your focus will be on the balance sheet, equity and liability side. You'll be looking mainly at capital and reserves or shareholders' equity plus your non-current liabilities. Just checking the movement there. You should be able to pick up the movement or the flows from those sections. Of course, with other information that must be considered, additional information that must be considered to assist you to determine accurately the cash flows from these two sections that I've mentioned, or from all other sections, from the three sections. Getting to your reconciliation, to the note of reconciliation between net profit before tax and cash generated from operating activities or from operations note. Look, if you look at that note, it consists of three things on top. If I've got to guide you and just put in some blinkers as you go, as you prepare yourself to go to the exam room next week, put in those blinkers, just what you need to know that what we have on top there is net profit before tax. To it you add depreciation, you add interest expense. And all of this information comes from income statement, just to assist you, so that you don't look around for information. You just go straight to income statement, and that is where you get this information to prepare the top part of it. And up there, we don't talk brackets. You must not even think of brackets. There are no brackets to consider. It's net profit before tax, you add depreciation, you add interest expense. The sum thereof is referred to as gross operating profit before changes in working capital. Please just remember that. Net profit before tax, add depreciation, add interest, and the sum thereof, gross operating profit before changes in working capital. And there are no brackets to think of. Right. And this will be followed by changes in working capital. Changes in working capital, three things that you must think of, that you must consider, not even to think of, that you must consider only. Don't put any additional item. We don't want to see four things there. It's only three things. It's inventory, it's trade and other receivables, it's trade and other payables. Changes in the three. Changes in inventory, changes in trade and other receivables, changes in trade and other payables. Three things to consider. And there, including the cash flow statement itself, of course, you need to apply brackets where, of course, applicable. But we'll come to that. Right. So there are three things that you must consider. An increase or a decrease in inventory, an increase or decrease in trade and other receivables, an increase or a decrease in trade and other payables. The sum or whatever difference plus gross operating profit before changes in working capital will give you your cash generated through operations amount. That you'll need to take to the cash flow statement under your cash flows from operations. And that will be the first thing to show there. All right. Now let us talk brackets, application of brackets in the cash flow statement. I think it is very important that we talk about that. It is important that you understand the relationship between cash and assets on the one hand and cash and liabilities on the other hand for you to be able to apply brackets properly. Let us go through this relationship. Let us say you have 1,000 rands in your pocket. You take 800 rands, you go buy stock. What will happen to your stock? Your stock will go up from 0 to 800. And your cash down from 1,000 to 200, right? And with time you sell stock. Say you have sold stock with 600. What will this mean? It will mean 600 rands in your pocket, your stock will come down, your cash will go up. Let me take another fixed asset, another asset. You go buy a vehicle for 200,000, your cash will be 200,000 less. The value of your vehicles will be 200,000 up. With time, you decide to sell, to dispose of this vehicle for 150. The value of your vehicles will be 150,000 less, or will come down, and your assets, your cash will go up. So from this demonstration, one can clearly see that cash and assets are negatively related, for they move in the opposite direction. Where an asset goes up, increases, your cash comes down. Where your asset comes down, your cash goes up. So the two are negatively related. Now, of what relevance is this insofar as application of brackets is concerned? Look, this is the relevance of this. If you say increase in inventory will mean a decrease in cash, and therefore you bracket the amount. A decrease in inventory will mean an increase in cash, and therefore it will mean do not bracket the amount. That's the significance of this relationship. That's why it is important. It is the relationship that will guide you in applying brackets. Right? The same can be said of trade and other receivables. An increase in trade and other receivables will mean a decrease in cash, bracket the amount. A decrease in trade and other receivable means an increase in cash, do not bracket the amount. You are looking here at the impact of the movement on cash. What impact does this movement have on your cash? You are not looking at your inventory, that is an increase in your inventory, and therefore that amount is positive. What impact does that movement have on your cash? It's got a negative impact. Bracket the amount to show that negative impact. We are looking at that impact, right? Let us look at the relationship between cash and liabilities. On the other hand, look, if you go to the bank, you have zero cash. You go to the bank as a business, you negotiate a loan, and you're granted a loan of 500,000. That will mean 500,000 in your pocket. Where you had zero cash, you now have 500,000. Where you had zero debt, you now owe the bank 500,000. You see, there's an increase in cash, there's also an increase in debt. They both have gone up. With time, you go pay. Say, you pay 200,000 to reduce your debt. It means you'll be taking 200,000 from your cash, and that will mean your cash will come down, will decrease, and your debt will also decrease. Can you see? The two are positively related, for they move in the same direction. I'm using this loan story as representative of all liabilities, whether non-current liabilities or current liabilities. This is representative of all the liabilities. Be creditors, be your shares that you are issuing, that means more cash coming in, shares that you are repurchasing, that means a reduction of share capital and so on. This is representative of that. So liabilities or cash and liabilities are positively related, for they move in the same direction. So this, what it means for cash, it means when there's an increase in trade and other receivables, an increase in trade and other receivables means an increase in cash, and therefore do not bracket. A decrease in trade and other receivable means a decrease in cash. Well, let me put it this way. An increase or an increase in your liabilities, decrease in loan, trade and other receivable means a decrease in cash. You need to put the amount in, you don't need to put the amount in brackets. But a decrease in your loan, in your trade and other receivable, in any liability for that matter, it means a decrease in cash, and you therefore need to put this in brackets. That is very important. The relationship that I've outlined here applies to both the note as well as the cash flow statement itself. For example, fixed assets purchased. It means you've used money to buy additional assets. Your money has come down, has decreased. Your assets have gone up. It means negative impact on your cash. So you have to put that in brackets. And proceeds from sale of fixed assets or assets will mean an increase in cash, and you therefore do not have to put that in brackets. It is extremely important that you understand this application. It is extremely important because at times, or oftentimes, candidates get penalized for not applying brackets correctly. So it is extremely important that you know how to apply brackets and when to apply brackets and when not to apply brackets. It is extremely important. Otherwise, if you don't know, you're not sure, you're going to shed away marks. So you're going to shed marks. And remember, you'll be out there to collect marks, not to give away marks. Okay. I was saying that we are going to have a short exercise again on the cash flow statement, just to check our understanding of all the things that I've been saying. How to prepare the cash flow statement, how to prepare also the reconciliation between net profit before tax and cash generated through operating activities, right? But maybe just before we do that, I want to explain quickly 3 calculations, with time permitting, of course. I want to explain 3 calculations. And this will relate to, these calculations will relate to calculating the fixed asset purchase, which is very important to me, calculating taxation paid, calculating dividends paid. All right? I'll do that by way of giving you some kind of a formula. Starting first with fixed assets purchased. Look, when calculating fixed assets purchase, I advise that you use the formula, the following, is it a formula or an equation, that take your closing balance, say closing balance, minus opening balance of your fixed assets. Closing balance of your fixed assets minus opening balance of your fixed assets. Add to this depreciation. Add to this disposals. Give the N. And that should give you the amount of fixed assets purchased during the year. Alternatively, you can have OB, opening balance, plus, I don't like to use X, but I'll have to put X representing the fixed asset purchase additions, minus depreciation, minus disposals, is equals to closing balance. You can use that formula, it will give you the same answer as the formula above or the equation above. Right? If you're not sure about this, we also advise that you draw some kind of a T account. Right, some kind of a T account where you'll have your opening balance this side, X amount, and you'll have your closing balance as a carry down here of X amount. Of course, it's a brought down the side, isn't it? And you have your depreciation, you have your disposals. Remember, it is not necessary that you put in these details, because where the question, of course, says calculate, you can have this T without necessarily putting in the details. Yeah. But make sure that you've got your opening balance here, you've got your closing balance as the carrying, as the carrying what you call, as the balance carried down. You have your depreciation as well as your disposal. That should give you the difference here. The difference here will then be fixed assets purchased, bank or creditors. But remember, I said it is not necessary that you put in details, because the question will be saying calculate. So we'll be looking mainly at the figures. So this balancing figure will then be your fixed assets purchased. Or if you're also not so sure and you're more comfortable with your fixed asset note, just have it in mind. Remember, a fixed asset note, you'll have there on top your carrying value at the beginning of the year. Slot it in. Then you have your movements. Your movements, you've got your additions, you've got your disposals, you've got your depreciation, right? Then you have your carrying value at the end of the year. Slot that in. Slot this in. Slot them in. Pull them. Then you'll have this, of course. Then add down this way. You should be able to get that figure. Add down or subtract down that way. You should be able to determine your additions at cost. That is one way of going about determining your fixed assets purchased. I want to move on to dividends. Dividends should be fairly easy to work out. Dividends paid. Dividends paid should be easy to work out. We know that it will be what you owe at the beginning of the year, what you owe or owing at the beginning of the year. This is easy. Plus the amount in the notes, the financial statements, amount in there, less amount owing at the end. Then that should give you dividends. But there's another way of doing it, which is very short. What you need to do is just where there is an interim dividend, where you are given the interim dividend amongst other amounts, and what you need to do, just take the amount owing the beginning of the year, and to it just the interim dividend. And that will give you, that be sufficient. You just end up here. What was owing in the beginning of the year plus the interim dividend, that will give you dividends paid. Straightforward. Dividends paid. And you put that in fixed asset, cash flow statement. Because these days they prefer it that way, that you show it on the face of the cash flow statement. Now, the only calculation that it's not difficult, but can be somehow, shall I say, tricky? Not really tricky. Somehow involved is taxation paid, tax paid. It is somehow involved, tax paid. It can be a bit complex in a sense. It can confuse some of us. Why? Because you may find yourself in a situation where you owe SARS at the end of the year, or SARS is owing you at the end of the year. You know, so it does not make the calculation that much easier and friendly. But I always advise that, look, where, for example, I'll give this example. You owe SARS. This is the amount coming from the previous year. You owe SARS 20,000 rands. And according to this tax calculation for the current year, they say you're eligible, you're supposed to pay additional 200,000. So in total, you now owe SARS 220,000. If you're to give SARS 220, you'll be owing SARS 0. You'll be owing SARS 0. It will then mean you shall have paid 220. But where they say you owe SARS 20,000 rands, what does this mean? How much did you pay? Because oftentimes this is what we're trying to determine. How much did we pay? You have to give SARS, in order to settle your debt with SARS, you have to pay SARS 220,000. You have made a payment, but you are told that you still owe SARS 20,000. It means you have paid SARS 20,000 less than what you're supposed to pay. So that is 220 minus that, it means you've paid SARS 200,000. If they say you owe SARS 10,000, it means you've paid SARS 10,000 rands less. So it means you've paid SARS 210. Let's change it. They say now SARS owes you. We maintain the same situation, we maintain the same information, and we are told that SARS owes you 50,000 rands. SARS owes you 50,000 rands after all of this. This is owed to you. How much did you pay SARS? It means you've paid SARS 50,000 rands more than the 220. So that means you've paid SARS 220 plus 50,000, which is 270. Right. That is the only trick. That is the only thing that you need to understand. So let us just change the situation. Say at the beginning of the year, SARS owes you, you're owed 20,000 rands. And the tax calculation is 200,000 rands. If you are to settle your debt with SARS, how much are you supposed to pay? The answer is you need only to pay the difference between what SARS owes you and what you owe SARS. What is the difference? It's 180,000. He owes you 20,000. Tax calculation for the current year says 200,000 must be paid towards tax. So all what you need to top up the 20,000 rands with how much? With 180 to arrive at 200,000. And you are told at the end of the year that, assuming the situation now, that SARS owes you 50,000 rands. How much did you pay? Because the question we're solving here is always tax paid. How much did you pay? That's all. The other information is always given. So in this case, it means you have paid 50,000 rands more than what you were supposed to pay, more than the 180. So you add the two to give you 230. It means that. Okay, guys. If you're not so sure about this again, it is advisable that you prepare the SARS income tax account. Very easy if you're comfortable with that, even if you don't give details. Let's take the first situation here, first scenario. You own SARS 20,000 rands, you'll have your balance there, 20,000 rands, if you like. And the tax calculation says 200,000. You must bring the 200,000 into account. Bring in 200,000 into account, you debit income tax and credit SARS with income tax, 200,000 rands. And you are told that you still owe SARS 20, let's make it 10,000. You owe SARS 10,000. It means This will be carried down 10,000. And it will be brought down 10,000. And the difference will be what was paid to SARS, which is 210. This is that's to your bank. That's all what you're determining. Where you owe 10, where you owe 20, it means you shall have paid 200, etc., etc. You can go this way. This way or this way, it will work either way. All right. Folks, thank you very much. I am going to, before we're going to have a working break. It's not going to be a break in the true sense of the word break. We're going to have a working one. You'll have this information on screen, and I want you to prepare this reconciliation between net profit before tax and cash generation from operating activities. Prepare also the cash flow statement. Prepare the cash flow from operating activities and cash flows from investing activities. So prepare the cash flow statement focusing on the two operating activities as well as the investing activity sections. Show your workings for dividends. Workings for dividends. For dividends paid, tax paid, and fixed assets purchased in brackets. Right? You will have this information on your screen within the next minute. Just be on the lookout for it. Okay, good luck. I'm going to give you time on this one. It's a bit long. It must take us, including your break time. Let us make sure that at least by 10 to the latest we're done with it. I guess that is not really, or 5 to. Let's make it 5 to. That just gives you 5, 10, 15, 20 minutes to do that. Okay, good luck. Welcome back, folks. I think you enjoyed the exercise. I'm very sorry that some of you are not able to see the screen properly, but pardon me. I guess you're able to pick up the relevant information and you're able to do two things only that I requested you to do. That is the reconciliation between net profit before tax and cash generated from operations, as well as parts of the cash flow statement for the year ended 28th February 2013. Right. Doing the reconciliation, remember I said earlier on that three things on top there, three things only. You must remember that. Net profit before tax, depreciation, and expenses. No brackets. You must not think of brackets at all. You are just going to add. You take those as given and put them in. If not given or overtly given, you must work them out to determine them. Oftentimes, will sometimes not give you the net profit before tax. They may give you, like in this exercise, where you have net profit after tax. We give a net profit after tax. If you can quickly rush there, go there. Remember again doing the top part of, let me just scroll, I'm sorry. Remember what I said earlier on, doing this top part of your reconciliation, the information, you get information from your income statement. That is the reason why I'll go straight to my income statement or an extract from the income statement. There you are. And from this, I need to pick up the relevant information. I've got my depreciation, there's 230. I've got my interest expenses, 65. Let me quickly go put those in. Let's go record those in. Depreciation, 230,000. 1, 2, 3. And your interest expense is 65,000. Let's have that, right? And we are given here net profit after tax. Am I right? Net profit after tax, 910,000. And the income tax is calculated or is 30% of your net profit. So what we need to determine is net profit before tax, which is not given. But we've got the information. We've got that we were told that income tax is 30%, was net profit after tax is 910. Right? Let's do the calculations to determine this. We should be able to determine net profit before tax. All right. Your net profit after tax is equals to 910,000, right? And your income tax is 30% of net profit. And we don't have the net profit before tax. These are not given. Right. What it means that your 910,000 is equals to 70% of your net profit before tax. Am I right? If your income tax is 30% and your net profit is equals to net profit before tax minus income tax, net profit before tax minus income tax is equals to net profit after tax. Right. So you equate this to 100%. You say 100 minus 30% minus income tax. That gives us 70. That this 19 is equals to 70% of net profit before tax. Shall I put it this way? Net profit before tax. Or we can have this represented by X if you like. Right. Let us solve for X. This is as good, it's the same as 170 over this. X is equals to 910. That's the same thing as above. Then you multiply this by 100 and you divide by 70. And remember what you do on the other side, on the one side of the equal signs, you must also do on the other side of the equal signs. In this instance, we've multiplied by 100 and we've divided by 70 because we're solving for x, which in this case represents net profit before tax. So it is 910,000 times 100 divided by 70. Let's work it out. Times 100 divided by 70. That gives us 1,300,000 as your net profit, before tax. Your net profit before tax is 1,300,000, and therefore your tax will be the difference between the two, which is in this case 390. Which is 390, if this is correct, minus 910 is 390. Or you can say 30% of this if you want to prove it. 30% of 1.3 will give you 390. Okay. So we now have the net profit before tax. We can go back to our note. Let's go back to our note and complete that note. Right. Now that we have determined net profit before tax, which was not given, but we are required to determine that. I'll just put this in brackets. That this is equals to 910,000 times 100 divided by 70, and that will give you 1.3 million. 1.3 million. So you add the 3, that will give you 1.5, 1.95, 1595 million. Let's check it. 123 plus 295,000. Yes. 1,595,000 will be your gross operating profit before changes in working capital. Then we get into changes in working capital. Oh yes, I've already put in these things here. Let me take them out. Let me remove this. Those will be changes in. Let's go to your balance sheet and let us take a look at our inventory there. What has happened to our inventory? Our inventory in 2012 was 490,000 and went down to 320,000 in 2013. That is a decrease in inventory of 170,000. 490 minus 320 will give us 170, and it's a decrease in inventory. Okay. So you write in here, sorry, decrease in inventory, and it's a decrease of 170,000 rands. What does this decrease mean for cash? It means an increase in cash, and therefore you do not bracket. Your focus should be not on this decrease in this item, but what impact does this decrease have on your cash? A decrease in inventory means an increase in cash, and you therefore do not have to bracket. Okay. Remember the relationship between cash and assets, they move in the opposite direction. Decrease in inventory means an increase in cash, or a decrease in assets means an increase in cash. And the opposite holds true. An increase in assets means a decrease in cash. In that case, you shall have to bracket now the difference. Okay, let's move on and check our trade and other receivables. What has happened there? Maybe I needed to explain to you when checking or measuring the movement of your trade and other receivables as well as trade and other payables, you must do so excluding SARS income tax in the case of trade and other receivables. That should not form part of that measurement of the movement from one year to another insofar as trade and other receivables is concerned. You must take that out, you must not consider that. Why? Because that amount is used somewhere else in the determination of tax paid. Coming to trade and other payables, you must also remove, or rather exclude, SARS where applicable, as well as shareholders for dividends, in measuring the movement of trade and other payables from one year to another. Again, the reason being, those amounts are used somewhere in the calculation of tax paid as well as dividends paid. Remember that. That is to say, you can't just come here, you can't just say, check the difference between 246,500 and 209 and say the difference there is 246,500 minus 209 and 300, and say now the movement is 37,200. That is an increase of 37,200. And write that down in your note. That will be wrong because that includes SARS income tax. You must remove that. Now, how do we do it? You look at your trade and other receivables. In 2012, you had SARS amount there of 25,000, right? So you subtract this from the 209, right? And in 2013, there's nothing. Then you can compare. Let's do that. So it is 209, 300 minus 25,000 minus 246,500, and that gives us 62,200. An increase of 62,200, right? Increase in trade and other receivables. Let's go there. Increase in trade and other receivables of 62,200. What does this increase mean for cash? It means a decrease in cash. And therefore, you need to put this in brackets. You need to put this in brackets. Remember the relationship again. An increase in assets means a decrease in cash. So we need to put that in brackets, right? Let's move on. Let us take a look at our trade and other payables. With trade and other payables, same story. Exclude SARS, exclude shareholders for dividends. Let's start with 2012. Let's start with 2012. Your total trade and other payables is 1012, 1,012,000, right? Minus the shareholders for dividends of 560,000. Can you see them? Nothing. SARS is 0, and your shareholders for dividends 60 minus 560,000. That gives us 452. I'll just put it here on my paper. 452,000. That is 2012. For 2012, it will be that 1,012 million minus the 560. That gives us our trade and other payables without the SARS and without the shareholders for dividends 452, right? And quickly, let's check. 2013, you had 1.6. You had 106,65,000, 1,065,000. You need to exclude SARS 10,000. You need to exclude SARS 10,000. You need to exclude shareholders for dividends 680. That means in total you must deduct 690 from 1065. How much would that be? 1065 123 minus 690. That gives you 375. 375,000. That is excluding. That's excluding SARS and shareholders for dividends. Now, once we've got this, then we can just measure the movement from one year to another. So, looking at this, there's a decline from 2012 to 2013, from 452,000 to 375,000, and that should be a decline of 77,000. Am I right? 452 minus 375. That gives us 72,000. There is a decrease from one year to another of 77,000. And that's the amount that will go to your note. This is the amount that will go to your note. As what is a decrease in trade and other receivables. Decrease in trade and other receivables of 77,000. A decrease in liabilities, whether non-current, current, means a decrease in cash. Cash and liabilities are positively related, for they move in the same direction. Decrease in trade and other receivables means a decrease in cash. So you'll put the 77,000 in brackets. And what you need to do, you need to add the 3. You add the 3, 170 minus 62,200, 170,000 minus 62,200 minus 77,000. That gives us 30,800. 30,800 as your change in working capital. As a change in working capital, or as a net change in working capital, giving us cash generated from operations or operating activities. Okay, that's fine. You need to add the 2, which will give us quickly 1.625,800. All right, 0 is 5, that's 9, 12, carry 1, 6. That will be your cash generated from operating activities, and this is the amount that will take straight to the cash flow statement. This is the amount that you must take to the cash flow statement, right? What you must remember, whether you're not so sure whether you've got that correct or what, don't get tempted to change it. If, for example, you have 2 million there as your answer, transfer that 2 million to the cash flow statement as is. Don't change it. Whatever you've determined here must go to your cash flow statement as is. Don't change it, because once you change this, you have it as 1,625,800. Then suddenly, when you come to the cash flow statement, the same what you call cash generated from operations now changes to something else, to a different figure, 2 million. You'll be losing marks unnecessarily, because that shows inconsistency. Because you're saying here it is 1.6. Next moment you say it is no longer 1.6. It's now 2 million. Where's consistency in here? Then you get penalized for that. You see? This may maybe say you've got this one wrong. You'll get penalized maybe here if we're not going to award marks for arithmetic. But if you transfer the very same wrong amount here as is, you're getting marks, you're getting awarded for consistency, for method. That you understand that this must go to your cash flow statement and a cash flow from operations. Right? It is important to take note of that. Don't jungle around with figures. No. Don't jungle around with figures. Pick and choose figures and write any figure that comes to your mind. No, it is not correct. You lose marks unnecessarily. Right. The next thing, you move on to check your interest expense. How much is it? Because there was no adjustment in your interest expense, you can easily just go to this 165, or it is there in the income statement as 65,000, and it is an outflow. Right, sorry, what am I doing now? 65,000. Right. Then you need to calculate dividends paid. You also need to calculate tax paid. Dividends paid and tax paid. I hear people saying taxation paid. I'm not so sure it's taxation or tax paid, but it's fine. Let's start with dividends paid. You have 560 that's owed to the shareholders at the beginning of 2013, or as at the end of 2012, right? Right. Let's put that figure. That will be your starting figure, 560,000. To it, you must add amount in the, or amount from the notes, or in the notes, sorry. Right. But looking at the adjustment for dividends, information regarding dividends, bullet number 1, an interim dividend of 40 cents per share on 500,000 ordinary shares was paid during the year. Now, this should be very easy for you. All what you need to do is to get the interim dividend by multiplying 500,000 ordinary share, multiplying that by 0.4 or by 40 cents, and that will give you 200,000. That will be interim dividend. You can stop there and say dividends paid is 560 plus 240,000, and finish and clear. Then you've got it as 800,000, an outflow. Rather than going taking a long route, others will say, which is a long route? I'll put it here. We'll have the 560 plus dividends for the year, which is the 240, right? 240 plus dividends owing at the end of the year, or they add the 2. You can easily add the 2. Some will add the 2 and say dividends for the year. Shareholders for dividends was 680. Can you see the 680 plus 240? That will give you 920. That's dividends for the year. 920. All right, let's put that 920 here. They'll have 920,000. It's dividends for the year. I'm just giving that as an alternative. Less dividends owing at the end of the year, 680,000. If you check it, you get to arrive at the same answer. Sorry, not did I say plus? Minus? Sorry, this minus. Minus dividends owing at the end of the year. Let's check it. The result will be the same. It's 560 plus 920 minus 680. That gives you 800,000. So why go all the way? Because the 920 includes the 680. You've included the 680 and you are taking it out. Why don't you just take this interim dividend once and for all? 920 minus 680 will give you the 240. So shortcut, where there is, of course, an interim dividend, just amount owing at the beginning of the year plus the interim dividend. Unless it is not given, I give and say 920 as dividends for the year. Where information says dividends for the year, it's 920. Then you'll have the 560 plus the 920 minus 680. Right? Okay. let's get to tax paid. Okay, let us take first the tax for the year. Tax for the year. It's 30%. We've worked it out. It's 30% of 1.3 million, which is 390, isn't it? We worked it out during our calculation. This was determined as, I'll just put it here, as 390, you remember. And our net profit before tax was 1,300,000. That's what we determined, isn't it? Remember the calculation there. All right? So our tax for the year is 390. We can start with it and say, in calculating taxation paid, we expected to pay 390. Let's go to our balance sheet and notes to financial statements we've got any, and just check your income tax. SARS income tax, that comes under trade and other receivables, right? At the end of 2012, or rather the beginning of 2013, if you like, SARS owed us 25,000. The tax calculation for this is 390 that we're supposed, but SARS still owes us 25,000. So all what we need to do is to top up we need to top up the 25,000 that is already in SARS hands to arrive at 390. By how much are we supposed to top that up? The difference is 365, which is basically 390 minus. It explains why. I will say minus. 380 minus 25,000. Remember, SARS owes us 25,000. The tax calculation for this is 390. So, in settling our debt, in squaring this up, we need just to top up what SARS owes us already, what he has on his end. In a sense, we've partially paid SARS 25,000. To make up the total payment, we need to put in the difference, which is 390 minus 25. Add the difference, which is 365. If you deduct 25 from 390, you will get the 365. Am I right? You can check it with your calculators. It's fine. That's the way I suggest you reason these things out during writing, rather than be talking of amount owing at the beginning of the year, amount owing at the end of the year, amount in the income notes and what have you. And when to bracket and when not to bracket can be a bit confusing. Just reason it to be simple that SARS owes you 25,000. The calculation, the tax calculation for this, you're supposed to pay 390. You already, in a sense, you've already paid 25,000. All what you need is to top up the 25. By how much? By the difference between 390 and 25, which is 365. Okay, good. That explains the reason why minus there. Yeah? Why minus? At the end of 2013, there's SARS at the end of 2013, under trade and other payables. What does this mean? It means we owe SARS 10,000. We owe SARS 10,000. What does this mean? It means we've paid SARS 10,000 less than the 365 that we're supposed to pay. Am I right? How much did we pay? 355. It means that. It means we've paid SARS less. So, less. That is the reason why we owe him. Say you say minus 10,000. We've paid him less. That explains why the minus 10,000. And how much did we pay SARS in total? It's 355, which is an outflow of 355,000. I think I need to explain this further. it is important that next week Tuesday you go there and collect full marks on this, on these calculations, full marks on these calculations. Look, tax calculations is 390. SARS owes you 25,000. To square up your debt with SARS, how much are you supposed to pay? You are basically, all what you need to do is to top up this 25,000 that SARS has already, that you have already paid in a way. With how much? 365. Take out what SARS owes you. So in essence, you now owe SARS 365,000, all right? Now you are told that you owe SARS at the end of the year. You owe SARS 10,000 rands. The question is, this is the question that is asked all the time. How much did you pay SARS? The answer to this means you've paid 10,000 rands less than the 365. That is why you say minus 365 minus 365 less than. This is what you see. 355,000. This is what you have paid. 355,000. That's the way you to reason it out. Right? So, in the cash flow statement, tax paid, as you have seen, $390,000 minus 25,000. There's the minus 25,000 minus the 10,000. You see, 355. Very easy if you reason it that way. I've seen jury marking a great number of candidates losing out, missing this calculation. Some will not even attempt it. Others will get it completely wrong, totally wrong. And you can't afford that. Please, that is what you cannot afford. And others will get it right, and maybe like this, and have the answer there under the what's called final answer is 355, and forget to bracket. Oh, you lose marks, you know. You lose the marks for not bracketing. And the way you've shown the calculations, at least you will earn part marks. You'll earn 1, 2, 3, and no mark for this because you do not apply the brackets correctly. Now, it becomes worse in an event where, or in cases where a student did not, or a candidate did not show brackets but has tax paid. He's done the calculation somewhere, and he writes, or she writes in 355 and leaves out the brackets. The whole thing is wrong. Then loses all the marks because of not putting the brackets. And look at this calculation, the thinking behind. All the effort, 0, ending up with 0. Now, where you've got it correct, you have it tax paid, 355, and you have it in brackets, and you do not show calculation, you'll get your full 4 marks. In some instances, we give 5 marks. Right? But it is advisable that you show brackets in case you make this kind of mistake so that you earn some marks in there. At times you may have something wrong here. You may have this as 365 or 375 where you've added the 10,000. Then you end up with 375. Where you've added the 10,000, you know, by mistake or the way you understand it, you'll end up with some will have it this way. Tax paid 390,000. I hope my big fingers are not obscuring your view. Minus 25,000 plus 10,000, ending up with 375,000. You see, you'll still earn some marks. You'll get a mark for the 390, you'll get a mark here, and no mark here. And you'll get a mark here for correct mathematics or arithmetic, because 390 minus this plus 10 will give you that, rather than getting a 0 at all. But if, say, you've not shown the marks, you've done it somewhere else, and you have 375, like this, tax paid, you end up with 0 instead of 3 marks. So it is therefore important that you show your calculations in brackets. I mean, your workings in brackets, and it is also important to apply the brackets correctly in the cash flow statement so that you don't throw away marks unnecessarily. Okay, back to the problem. Right, we have our tax paid as 355. Then moving on to fixed assets purchased. Let's get to fixed assets purchased. We'll do the additions hereafter. Looking at your fixed or tangible assets, that's 2.4500. Pardon me, it's 2,450,000 in 2012. The opening balance, and the closing balance is 2.8 million. Remember what I said. Let's start first with maybe the closing balance and determine this. We'll say 2.8 million minus opening balance 2.450. Sorry. And I've said plus depreciation plus disposals. Your depreciation is 230. We've got it as 230. Plus your disposals. Looking at the additional information supplied under fixed assets, you have an old delivery vehicle. An old delivery van was sold for 150 rands cash at carrying value. Cash at carrying value. This in brackets. Was sold for 150,000 rands cash at carrying value. So that is disposals carrying value. So plus 150. Plus 150. I'm sure you can't remember. You can't forget this. You can't forget this. I'll advise that you stick with this one. It's very easy. Closing balance minus opening balance plus depreciation plus disposals. You can't tell me come Tuesday you shall have forgotten this. No. Let's weigh it out. 2,800,000 minus 2.45 million plus 230,000 plus 150,000, and that gives you 730,000. I hope this is correct. And that is all. Come on. 730. That's all fixed assets purchased. Or rather, that would be the cost of an additional storeroom built if you look at your additional information. So this is an outflow of cash. The impact is negative on cash. Remember, there's an indication there that an additional storeroom was built on the year. For how much? This is what we're trying to determine. That was built for 730,000. That was built for 730,000. We can work it out again differently here. Quickly, if can I have it this way? Let me see. Remember the other formula said you can have it as the opening balance, 2.450 plus X minus depreciation, or depreciation is 230,000 minus disposal 150,000 is equals to your closing balance of 2.8 million. Right? Moving on with this calculation. Oh, sorry, now where does this come from? Moving on with this, you will have X equals to 2.8 million, 2,800,000 minus, this is 2, what has happened to my 2 here? This was 2 million. Minus, because this is crossing the brackets, it's minus 2,450,000. This is crossing the equal signs. When you cross the equal signs, the sign changes. And the minus 230 becomes a positive, okay? Plus 230,000. And the minus 150 becomes a plus 150,000. You can check it. X will be equals to 730. That is basically what we have up here. 2.8 minus that, plus that, plus that. That will give you 730. Or you can go the ledger account way. You can go the ledger account way. You can show this by means of a ledger. Where you are not sure, you can just drop a T quickly, a T account. Let's do that. You can have your T account like I indicated earlier on. Your opening balance is 2,450 million, and the closing balance is 2,800,000, which will be your, that's your closing balance, 2.8 million. All right. And then you have your depreciation of 230,000. Credit this with depreciation, and with disposals 150,000. Remember, I said details are really not necessary because you're required to calculate. Adding this together, that gives us 0. 3 plus this is 8, 10, 11, carry 1, that gives us 3,180 million. This is 3, pardon me. And the difference will be 1, 2, 3, is 0, is 3 to give us 87, and that will be purchases. Fixed assets purchased, bank or creditors control, 730. Same answer. Same answer. Or alternatively, the last one, you can approach it the fixed asset note way to say, what was the carrying value at the beginning of the year? It's 2,450,000. And the movements, if your additions at cost unknown, disposal is known, 150,000. Depreciation is known or given, 230,000. Carrying value at the end of the year is also known, 2.8 million. Then you must determine that. Add, subtract to arrive at that. That's 2,450,000 minus or plus minus 380 minus 2,800,000. 730 is the difference. Then you put in 730 here as your additions. Either way that you're comfortable with, but I'll strongly advise, for the purpose of time, to save time, just have your closing balance minus your opening balance, have it this way quickly, like I've shown you in the answer here. Closing balance minus opening plus depreciation plus that is very easy. Then you get your full marks, 1, 2, 3, 4, 5 to 6 marks. Then your fixed deposit, movement in your fixed deposit, well, that is straightforward. In investments, from 600 to 750, so there's an increase in investment of 150. And that says a decrease in your cash flow, 150. That will lead to a decrease of 150 in your cash flow too. It's an increase in investment, a decrease in that. Increase in investments, a decrease. Increase in assets, a decrease in cash. Right. And all what you left to do is to add up, which I'm really not going to do now. It's straightforward, it's additions, but you need to do in the exam room. You must add up. It's 800,000. Let me quickly add up. And the up here, it's 16625. 800 minus 865 minus 355, and that will give you 405, 800. That is all what you needed to do, and I'm sure this is quite easy. I'm sure you agree with me. This is manageable. You can do it. Don't shy away from doing the cash flow statement. You'll always get it in the question paper, and just this is the way to go. We're going to have another exercise after our break so that you can work on, because I want you to have the feel. You must be confident next week Tuesday as you go in there, come into the cash flow statement. It was never difficult. It is not difficult. You can do it. You can certainly do it. Right. We're going to have a few minutes break. Let me get an indication from my producer there. We're going to have a 5 minutes break. Thereafter, we'll converge. I will give you a short exercise again. It's not really that short, but it will be again on the cash flow statement. Remember, I still have the stock valuation methods to do. With time, I doubt whether I'll be able to do much. We've got very little time left, or maybe I should step off the cash flow statement and do that, because at 12:30 we need to break. I think I'll try to move on to the stock valuation methods after our break. Thank you very much. Thank you. Guys, welcome back. I got a question on the calculation of the dividend, dividends paid, and was asked how did I arrive at that figure of 800,000. I said 560 plus. I think my mistake, you guys are correct. I think you're very, attentive. Thank you very much. Because an interim dividend is 500,000 shares times 0.4, and which should be 200, not 240. Thank you for alerting me to that mistake, and then this will be 760. Right, this will be sorry, now what did I do? This is 760. Thank you, folks. That was a mistake on my part. 500 times 0.4 is 200,000 rands, not 240 cents. You know, working with figures, this kind of mistakes, they do okay. You know, you read 4 as 0 at times, or 40 as 14. It's possible. Thank you very much. I hope I was able to answer, to address the question and to correct the mistake. Thank you. Just before we went for break, as I've said, I indicated that we'll be, after break, we'll be moving on to do the stock valuation methods because we don't have much time left. And I want us to do just that quickly. We are going to do the stock valuation methods very quickly because we only left about 20 minutes. And I'll be giving you this exercise that is showing now on your screen. You can take a look at it in the meantime whilst I'm providing just general guidance around the what you call stock valuation methods. I'm not going to get into the specific method. We're going to talk FIFO as well as weighted average. And I'm going to ask you to determine the following values. I'm going to ask you to determine the value of closing stock, or calculate the value of closing stock using first FIFO, later on using weighted average cost. I want to do the two. And also we need also to calculate the cost of sales using first FIFO and later on the weighted average cost methods. Right? When using the FIFO, stock valuation method, remember that is the stock that we bought first or that got in first is the first one to go out. If, for example, you have sold 1,200 units, you are told that 1,200 units were sold. So it will mean then this 1,000 is gone and 200 of the 800 is gone. How many units of stock are you left with? For left with 600 plus 1,002 plus 900, which is 2,007. Right. And what will then be the value of that stock? It will be 600 times that, 1,002 times that, 900 times that, right, etc. And using weighted average cost, what you need to do is to determine the weighted average cost price. And how do you get that? You divide the value, the total value of your stock by the number of units bought. Then you've got your weighted average cost price. And to determine the closing stock, the value of closing stock using weighted average cost, you need to multiply the remaining stock, number of units remaining, by the weighted average cost. Then that will give you the value of closing stock using the weighted average cost method. And if you want to determine the cost of sales using a weighted average cost method, you multiply the number of units sold by the weighted average cost. Very easy method to use compared to the FIFO, first in, first out method. For the purpose of this exercise, I've left out returns for starters. I want us just to do this short exercise, which should not take us long. Because we don't have time, I guess 5 minutes will do. 20 past we must be done. Work out the value of closing stock using FIFO. Work out the value of closing stock using weighted average, as well as the cost of sales using both. Okay, 5 minutes. Thank you very much. Okay, folks, let's do this quickly. We don't have much time left. Let's get the solution. I think you've got it right. This is easy meat, easy stuff. I don't think you had experienced challenges on this one. Right, let's go to the closing stock, value of closing stock using both methods, closing stock, closing stock value. Right. Let me put in a table quickly, maybe just to make things a bit neater. It's fine. Here we'll have units of stock remaining, of closing stock. Then we'll have your FIFO here, your first in, and we've got the weighted average cost. How many units are we left with after this sales transaction? Our selling price per unit is 25 rands a unit, and we've made sales of 60,000. To determine the number of units sold, you divide that 60 by 25. 60,000 divided by 25. It will give you the number of units sold. Number of units sold would be 2004. 2004. If you have sold 2004, how many units are you left with from the 3009? You are left with 1005. Am I right? I'm just putting this in red. It means you're left with 1,500 units. So the question is, what is the value of this closings of these units? What is the value of your closing stock units in simple terms? Using the first in, first out method. Units remaining, got 1,500, it's fine. Using FIFO, all what you need to do is go back to the table and try to locate the 1,500 units. Where are these units located? 900 plus 600 of this. These were sold. 1,000 were sold, 800 were sold, plus 600 of these units were sold to arrive at 2004. So you're left with 600 units here, right? You're left with 600 units there. FIFO, it will be 600 units remaining times the unit price of 14 rands. Of 14 rands. Which is equals to There's 600 times 14, 8,400 plus the 900 units remaining at 15. There we've got the value. They don't have to go through this exercise. You just have to, you don't have to do this, but I'll do it, times 15, because it's given already. Use 13,500 from the table there. It should not be a problem. 13,500. And that will give you, come on, this is 21,900 using FIFO. That will be the value of closing stock. And they're using the weighted average cost method. You need to determine the weighted average cost per unit, which is the total value of 49,900 divided by the number of units, and this will give you, I should have told you that you must run this off to the nearest rand, but oftentimes in the question paper they'll always give direction in this regard, that whether to run it off to the nearest rand or to 2 decimal points, etc. Right. Divide by 3,009. That gives us 12 rand 80. 12 rand 80 cents is the unit price, as the weighted average cost price. Right. And how many units are we left with to determine the weighted average is the number of units remaining after the sales transaction of 1,500 remaining units times the average cost price of 12.80, and that will give us 1,005 times 12.80, 19,200. 19,200. I know others might have rounded off to the nearest rand, giving them 13 rands. It's fine. But in the question paper, there will always be an instruction or some kind of guidance as to the rounding off, relating to the rounding off, whether it's to be rounded to the nearest rand or to whatever decimal point, right? That's the value of closing stock using the 2 methods. Now, if you get to your cost of sales, if you may bring in the cost of sales here quickly. Of sales using FIFO, it means you must go back here and say, these units, the 2,400 units, how much did they cost you as the trader? How much did you pay for them? You bought them for something. How much did you buy this? So 10,000 plus 9,006 plus half of this, 600 times 14. So that will mean the cost of sales using FIFO would be 10,000 plus 9,006 plus the cost of the 600 units at 14, which is 8,004. Is equals to, then you add the 3, 19,006, or you can go this way, is 10, 18, is 28,000. That should give you 28,000. That is the cost of sales using FIFO, and the cost of sales using the weighted average will be the number of units sold, 2004, times the weighted average of 12.8, 12.8, straightforward. 2,400 units sold times 12.80, which is 30,720. Weighted average makes life very easy. It's very easy to work with, right? We can play around with this. We can change the number of units sold. We can change the number of units remaining after sales. Quickly, with the last few minutes, I want to explain something here. Let us say you have your returns sometime in June of, say, 500 units were returned in June. As I call them red 2 or blue, whatever. Let us have them red 2. 500 units were returned in June. And your closing stock, the value of your closing stock, say it's the number of units remaining is 980. Okay, determining the value of closing stock is same procedure using FIFO, and of course it's the same procedure using weighted average cost method. But you may be required to determine at times. If you look at this, you've got 3,900 units, you've sold 2,400 units, and you've got 908 units remaining. It means you must have lost some units somewhere. Am I right? 2,400, unless this is not correct, plus 5. Those are the returns. Sorry. 3,009 minus 204 minus 500. Right. Given this kind of information, you may be required to determine the number of units missing or lost. In this case, what you need to do, you say these are the total units bought, minus units returned, minus units sold, and minus units remaining. Then that will give you the value of closing stock, the number of units lost or missing. That's what I'm saying, and I'll squeeze it in here so that you can see. You've got 3,900 units, total units bought, minus the returns, minus units sold, minus units remaining. This must give you 0. If it gives you something different than 0, more than 0, it means some goods got lost. And in this instance, that is the case here. 3,009 minus 500 minus 2,004 minus 980 is equals to 20 units got lost. Those are the number of units lost. And you may be required to determine the value of those units using either FIFO or weighted average. Using FIFO, what is the value of those units? These units lost, using the weighted average, it will be 20 times the 12.80. And if the lost units were lost, it will depend when were they lost. In June, in April, in May. Then you'll multiply the number of units by the unit price in that month to determine the value of units lost using the first in, first out method. But using weighted, just number of units times the weighted average cost. Okay. Guys, this brings me to the end of this presentation. I wanted us to do more, but unfortunately we don't have much time. I am only happy that you'll have these presentations going on in accounting. I guess this week there will be somebody in Tatemasang will be making some presentation on a number of topics. The asset disposal, the fixed asset note, the reconciliations, and the income, which I touched briefly on earlier on. And maybe you'll only add again them. The balance sheet, I did not go into town with it. I only explain it using ratios and so on. I think you'll also dwell on that. I can only wish you the best of luck for the forthcoming examination. Remember that paper is not easy. That paper is not easy, and question papers were never easy. They were always simple. All what we expected to do is to go out there and simplify this further. Remember what I said earlier on, you're not supposed to follow, or you're not expected to follow, in answering the question paper, the order of questions, that you've got to start with question 1, 2, 3, 4, 5. Pick up, start with the questions that you understand best, that you think you're more comfortable with, and collect those marks. Even in the so-called, or in those questions that you think you're not that much comfortable, but there will be portions, there will be areas or sub-questions where we can easily collect marks. Go there and collect those marks. Don't forget your ratios. Don't forget to memorize your formulas, please. I want to thank you for listening. I want to thank you very much and wish you once more the best of luck. We want to see you passing next year. Thank you very much. Pleasure. Bye-bye.